down 74% in 2022. Is Fiverr International stock a buy for 2023? I'm going to answer that question in this video using several different metrics, so let's get right into it. The first thing I'm going to look at is Fiverr's revenue growth quarterly going back several years before 2019. What you see is very nice growth that fuel was put on the fire in 2020 during the pandemic, and then it's kind of stabilized and it's coming down a little bit more recently as it's having a difficult time comparing with the boom time it experienced during the pandemic. Quarterly revenue reached 82.5 million in its most recent quarter, and the company does expect double-digit revenue growth in the current year, so it's not reversing, or it's not going to zero completely, just slowing down from the incredible rates of growth from 2020 and 2021. The next thing I want to look at is operating income, and Fiverr was doing a really good job in expanding, getting closer to profitability, and then more recently that has came down dramatically, and then it's trying to turn things around. Of course, it announced a major restructuring cost cutting measures in earlier June, July. The company, because of the type of services it offered, it was able to detect the slowdown earlier in the year. Around March, management said that it started to detect the slowdown in the industry. Growth started to become more expensive, so it really started to recalibrate its expenses, and it said that it's starting to pay off. So let's see if it can return to that trajectory of getting closer to profitability as its revenue continues to grow by double digits and it has slimmed down its expenses. Next, let's look at its cash flow from operations. And even though the company is not profitable on the bottom line, it's staying positive in terms of cash flow from operations for several quarters. More recently, earned 5.7 million in cash flow from operations. But even if you ignore this dramatic slowdown and recovery in 2019, it's showing a steady upward trend in terms of cash flow from operations. So in that regard, it's doing well. And tech companies often can do this where they're not profitable on the bottom line, but they're generating positive cash flow from operations, and that's because they can use a lot of stock-based compensation, pay their employees in stock options and stock grants instead of paying them in cash wages, and so that helps them achieve positive cash flow even though they're not profitable on the bottom line, because they still need to account for that stock-based compensation as an expense on the income statement. Okay, so that's where that difference comes into play. And so that's what you're seeing here from Fiverr International. Not profitable on the bottom line, but generating positive cash flow from operations. So given that I mentioned earlier they're doing stock-based compensation and stock grants, what you want to look at as an investor is how that's impacting average shares outstanding, because the more shares that are in existence, the more shareholder dilution. It means the fewer earnings per share will be when the company does eventually become profitable, right? Because you're taking that $1 of earnings and you're splitting it among more shares, and so the earnings for each share will be lower if there are more shares outstanding, and so you want to check for that. And for Fiverr, it's not too troublesome. They had average shares outstanding about 25 million before 2019, and that has increased to 37 million in late 2022. So about 12 million shares, or just under 50% shareholder dilution over about 4 years time. Uh, it's not small percentage terms. It's not small, but I've seen worse in terms of tech stocks that are paying out in stock-based compensation. Finally, let's look at its valuation, and I use the price to sales ratio and the price to free cash flow to determine if the stock is relatively cheap or expensive. And looking at its price to sales ratio of 3.5, It's the cheapest it has sold for in this metric going back to all the time we have data for, which is not very long in terms of Fiverr International. It's a relatively new publicly traded company. And also the price to free cash flow of 45.74 is also the cheapest it has sold for going back to all the time we have data for, which is again not very long. Still, even though it's relatively the cheapest the stock has sold for in its own history, I wouldn't say that these valuations are cheap. A price to free cash flow of 45.6 is not very cheap, and especially considering that the company faces near-term headwinds, I would not be wanting to pay this kind of premium valuation for Fiverr's stock. So, to answer the question posed in the headline, is Fiverr International stock a buy? I would say no, it's not a buy for 2023, not just yet, not at these valuations. All right, that's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.